Hey everyone, my name is Jordan. Welcome to Cover Call ETF Investing. In today's video, we are doing the next chapter in a series of Cover Call ETFs. The last video I did on it was technology, which is vital to the US economy. The next one we're covering is what is vital, absolutely critical to the Canadian market, biggest by far, and that is financial. So today we're going to be talking about 4 funds that have different structures to them, as far as cover call coverage and moneyness. And if that is something you're not familiar with, then I just encourage you to check out some of my other videos or scan YouTube for what exactly this cover call ETF business is all about. So why even bother talking about sector cover call ETFs when there are other cover call ETFs out there that are called all-in-ones? They are ETFs that hold a bunch of other ETFs, and we can call it a day, just invest in those maybe and be done with it. But I think that there's, like all things in life, there is more nuance to that, and of course this is no different. So if you're someone maybe like myself who is fully into cover call ETFs, I do use all-in-ones, but I also do use sector cover call ETFs as complementary positions and as yield boosters as well. Maybe you're someone who has taken up a different strategy and maybe only invests in a handful of cover call ETFs, and it's not maybe the biggest weighting in your portfolio, but perhaps there's a target yield you're after. Well, sector cover call ETFs are a lot more concentrated. And because they are a lot more concentrated in with maybe a select number of funds, they typically can have a higher yield than, say, all-in-one cover call ETFs. That's what we're going to see today, is that some of these beaten up Canadian banks specifically, cover call ETFs, have been bruised and need a few band-aids on it, but before they get the healing that they deserve, we should be taking advantage and buying these up while they are kicked down. So let's go over some of these funds, the structures, and then we'll get to the price performance here, and we'll also do a side-by-side comparison with this Vangaurd ETF comparison tool that will give us just to look at a comparison between management fees and yield and the holdings. So let's start with BKCL. BKCL is a new fund to the Canadian market. It launched mid-July or early July. It is an ETF that holds one ETF. It holds BKCC, which is both are by Horizons, so there will be no doubling up on fees or anything. So BKCL holds BKCC, which holds an equal weight, the big 6 Canadian banks. BKCL holds that one ETF and puts 25% leverage on it, so borrowed money. As I said in the last video, which I'll say again here, there are some benefits that are worth considering with leverage funds. The one being that these fund managers are very well connected. They are able to negotiate interest. I'm sure they're able to negotiate interest rates and bulk discounts when they actually buy their stocks to put in the fund and package it for us. Anyway, simply tools that they have that we could never dream of. As an example, BKCL, with it only being out for a month, we are not going to know the full MER from trading costs, the management fee, and the leverage costs as well. My guess it'll be in the 2% range. For the critics out there, no doubt you're going to probably say something, well, that's similar to a mutual fund, so why would I invest in this? Why not get the plain old vanilla S&P 500? Well, I would say to this, back to, as we come full circle, negotiating bulk discounts, perhaps on interest rates. This is more of an educated guess more than anything. You're probably going to pay an extra 1% for the leverage. But if you go take a loan from the bank or from your buddy or from a loan shark, which I would not recommend, it's probably going to be at the low end, maybe in the 6% range, 7% range. Personal line of credit, who knows what that, at 9%. You take out margin in a margin account. What's on Questrade? That's probably in the 8%, 9% range, like crazy. Or you can invest in one of these funds and pay 1%. So there is that. The other two with leverage and what it offers is it can act as a time saver. So a $4,000 investment is going to act like a $5,000 investment. It's going to boost your yield, and it's going to boost your return or your price return as well. It's going to help to offset the drag, which cover calls are known to lag behind if they are trying to mimic an index, and especially if the market takes up into a really strong bull run, the cover call ETF will underperform even on a total return basis. But the leverage can help offset that a bit. A lot of these funds are newer, so we don't have, say, 10 years of that kind of performance, but the general take is that's what they are meant to do, help to offset the drag. Okay, so that's enough with BKCL. The next up is CIC, again, 6 equal weight banks. Not much to say here. Holds the 6 Canadian banks in equal measure. There might be some discrepancies between all of them when they say equal weight. Maybe some of them actually might be, they might weight certain ones a little bit more than the other. So CIC does up to, I guess, 25% coverage at the money. Before I forget, CIC is by CI Financial. So, okay, ZWB by BMO. They do up to 50% coverage out of the money. And then we have HMAX, which is by Hamilton ETFs. They do 50% coverage at the money. Now that that's out of the way, not much to talk about as far as performance is concerned. CIC and ZWB perform almost in lockstep with one another. And then we can see BKCL during its inception in early July of this year. It mimics what CIC and ZWB are doing. HMAX lags behind. Now, just for, of course, transparency purposes, I'm actually invested in both BKCL and HMAX. They both hold about maybe 4% each in my portfolio for a combined 8%, and then I invest in a couple of different U.S. banks at 1% to make up about 10% of my portfolio for a sector cover call ETF in the financial sector. Now the question might be, why is HMAX lagging behind everything else? It looks like it follows a fairly similar pattern as the other ones, which makes sense because HMAX also holds the big 6 banks, but they also have some life insurance and some other, and I believe one other financial services company in it. Why exactly it is so it lags behind these other ones and doesn't hold lockstep like the other ones do? Maybe perhaps it has to do with just during its inception. There's probably the market, of course, trying to figure out how to value this. I think, yes, the underlying kind of helps to value it, but also as an ETF, we are buying those units, and simply that supply and demand balance to try to figure that out could play a part. But that's just kind of more of a I hope that's an educated guess. But then another kind of interesting point to note, even though HMAX lags behind, it does offer a substantial yield, especially if you are going to be dripping that. And if you don't know what a drip is, dividend just means reinvesting the dividend. It will hopefully allow you to offset the bit of underperformance here. Now, another kind of interesting point to note is BKCL is actually seeming like it's performing in lockstep with some of the less aggressive cover call bank ETFs, CIC and ZWB. Now, of course, over the long haul here, this will be a really interesting one to just keep in mind because, as I said, the leverage component is meant to offset the drag that maybe a more aggressive cover call, like say HMAX, which is aggressive with its call options, but doesn't have the leverage component. BKCL does, and it looks like just on a pure performance level, it's keeping up with the less aggressive calls. So that is perhaps a good example of where leverage can be your friend. Of course, in the long term, and you hold it for a good chunk of time, like I plan to do, it's meant to be more of an ally than your enemy. Okay, so we've gone through performance. There's not much else to look at here. Let's just go through the side-by-side fund comparisons. We can see the Morningstar category, financial services, MER, which is management expenses all in. This would include your trading costs, your management fees, your leverage expenses as well. The reason why these two aren't shown is because their inception dates were earlier this year. So HMAX was back in January, and of course BKCL was just last month, whereas the other two funds have been around for well over a decade, very well established that way, so we get full MER picture. So this cost is more in the normal range for cover call ETFs. I want to say HMAX is probably about 0.65 if I remember correctly, and BKCL probably in that range. It actually might be a little bit cheaper. I think its underlying BKCC, it might be in the 0.39 range. Okay, and then plus your leverage expense, which is probably in the low 1% range. Again, a total guess there, but I would imagine it's in the 1% range, and it probably also has, again, like some trading costs as well, maybe closer to 2%. But again, you perhaps could be getting that leverage if you're okay with that at a bit of a discount. I'm no fan of consumer debt, so if you're borrowing money for a TV or a boat or I don't know, just some other consumer item, not a fan of. I've been through that before with a new car. It'll never happen again, and it hasn't happened. So I pay everything with a credit card and pay it off every month. Okay, so looking at that, and HMAX, we said 0.65. Let's see, nothing else. I kind of mentioned what the fund names are: Horizon, CI Investments, BMO, and Hamilton. Total assets under management. So with this being a new fund in 1 month, hey, that's an impressive start. 16 million, especially in the Canadian landscape, in a fund or in a style of investing that is growing, but has it just blown the barn doors open, and it's absolutely mainstream, becoming a lot more mainstream, becoming a lot more normalized in portfolios, but nonetheless still an impressive start for Horizons with BKCL. CI been around for a while. It just chugs along with 166 million as a Canadian fund. I think that's decent. I don't think that's by any means that's undervalued or it's super impressive. I just think that seems like, for what it is, it's probably a decent number. ZWB by far, I mean, hands down in Canada is probably I'm like 99.999% sure that it is the biggest covered call ETF by a long shot, $2.811 billion. And then we have HMAX with an impressive, astounding start to its first year in inception with almost $500 million. Very impressive. Then we got the top holdings here. These are not updated. They all hold basically 6. They're like these 3 here basically hold 6 funds, and then this holds the 6 banks plus, again, a couple of extra positions with insurance companies and a financial services company. But this probably has more to do with like the call options, and they take up, I guess they count as a position. And this is all, of course, just a good reminder that These, say, comparison tools, I believe TD has one if you do direct investing with them. I've tried that out. There are other ones out there, but always, if you want the most up-to-date information, go to the fund manager websites. I think that is critical. Absolutely do that. Okay, and we already went over inception dates. We can say yield. We can see with CIC in the 8.34% range, ZWB 7.46, trailing 12-month yield, I'm guessing that is. Of course, with these funds not being around for that long, it doesn't show, but HMAX is somewhere, I want to say, close to 15%. And that's more on if you took all the distributions and then averaged them out for a full year, it would be about close to 15%. There has been, I believe, there's only been one distribution for BKCL so far. And again, if you average it out, the forward yield, forward 12 months would be probably about 16%. So whereas these two are trailing at the moment, these two we don't see them. So we just simply have to go on a forward 12-month basis. And so we got 16% and close to 15%. You can see since inception with BKCL up 2.45%. Again, you just simply have to, and that's a total return. That must be a total return. And then CIC, hey, not bad. For these two older funds that hover kind of you got ZWB in the 8% range, and of course CIC in the mid 8.5% range. Okay, and then HMAX is negative 1.09% total return. Okay, so anyway, something to keep updated on, which of course is the total return performances. So we can see that, well, it looks like for just the fund comparison, they attached the leverage to the ETF inside of BKCL. The 125% really shouldn't be shown here. It should just be 100%, right? The fund holds 100% of its own funds, right? It's a pretty self-explanatory way to look at it. And then 25% is added to the fund, on top of the fund, for the leverage component, bringing it to 125%. Okay, and then we got CI. Again, these are the big six Canadian banks, fairly equally weighted. And those extra positions I talked about were all the call options for all of these. And either way, they hold is those six Canadian banks. Okay, and then here we have BMO with, of course, the self-serving biggest position in their own portfolio, which is BMO. It's it's not the BMO position itself. It's the actual ETF. Really? So I'm gonna have to look into that. So I don't understand. So it's like an inception fund. It's like the fund holds its own fund. That can't make sense. That is totally weird. That the ETF would. Oh, never mind. Oh, equal it. I see. Okay. I think I know what's going on here. Okay, so ZWB holds ZEB, which is just the regular BMO Equal Bank ETF without any of the cover calls. Plus, they've also bought up the individual positions themselves. So, why they did that, I'm not sure. Because when I was doing a review of this fund before the video started, I didn't capture that. So, that's interesting. But okay, so they do hold, essentially, I guess, by holding this, they hold more of they are kind of, I guess, bringing more business to BMO by doing that. And I guess adding more to this fund as well with holding it inside ZWB. So that's a way for ZEB to grow a little bit more simply by being held in here, and then it has that cover call coverage put on it. And then we have HMAX, which it holds, again, the 6 with Manulife, Sun Life, Intact Financial, and we got some Brookfield in there as well. And then some trading information, risk and volatility, not much else to speak of here. So that will wrap it up for this video with financial cover call ETFs here in Canada. If you like what you saw, as always, do the cliche thing and hit all the buttons of the like and subscribe variety. I will see you all in the next video.